European banks across the continent are about to undergo their own stress tests. We'll get the results July the 23rd, but the question is, are these tests stressful enough? Let's ask Anders Aslund, Senior Fellow at the Peterson Institute. Anders, what do you make of the stress test as currently structured? Is it stressful enough?
Yeah, I think it essentially will clear the air. We are now having exactly the same discussion as we had about the US bank stress test in April 2009. After the results had been published, all this discussion was gone. And we can see already for the last week, we have seen a tremendous boom in European bank stocks after the announcement was made about when the bank stress test will be published.
But if we do find out that a number of banks do, in fact, need to raise additional capital, is the market ready to provide that? Or should we be concerned that states might have to inject more? Irish Prime Minister just said that they're ready to inject more in Anglo-Irish Bank, should Anglo-Irish Bank need the help.
Sure, some countries will have to inject state money into private banks, and the two big cases are Spain and Germany. It's very striking. Among these 91 banks, 27 are Spanish and 14 are German. So these are the two big focuses.
But will the market be able to, will they be able to go out into the marketplace and raise that capital? I mean, if we're talking about austerity measures perhaps being too severe or not being severe enough, isn't it worrisome to add to a state's balance sheet even more?
Yeah, but the numbers that are mentioned already are not all that big. For Spain, people talk about 45 billion euro that is needed in the savings banks, and about they will be merged into about half as many. In Germany, it's primarily the Landesbanken, the regionally owned state banks that will need more capital, but also there it will be a similar amount. So the ballpark of a guess would be a couple of hundreds of billions of dollars, which is not all that much money.
Well, there are 91 banks on the list being tested, but talk to me about some of the smaller financial entities out there, and then the bigger question about states and the questions about default on their debts. Does this completely resolve the sovereign risk question?
No, it will not. The assumption of the bank stress test is that there's a 17% decline in Greek government bonds. That is a haircut of 17%, and 3% of the Spanish bonds. And of course, there have been complaints that these are too mild assumptions, that the Greek haircut could be 50%. But even so, when people get these numbers into the equation, they can get a much clearer picture of it. This will provide more information, more transparency, and therefore more security.
All right, Anders, thank you for sharing your perspective.